welcome Thomas Galloway, Partner and Chief Financial Officer, Riverbend Energy Group. Dennis Kissler, Senior Vice President, Trading Division, BOK Financial. Billy McCartney, Founding and Managing Partner, Wincoram Asset Management. Along with our moderator, Hart Energy Senior Technical Editor, Richard Stubbe.
There we go. There we go. All right. Welcome. We're going to talk about hedging and the outlook for oil and gas and what these folks are planning to do about it. I thought I'd just start by reviewing where we are now, which you may have heard that oil prices were up in the 70s and now they're down in the 60s. Just checked before we came in, it was about $63 a barrel, with natural gas futures at about $3.70 with both of the futures curves in backwardation. So sort of thinking that prices are going to go down. And Dennis, we agreed to start with you. You are bullish.
I am a little bullish.
Tell us why.
Well, I mean, when the way the curve is set up, like you said, we're in a backwardation type structure. And we see that front month futures over the back end futures, especially like I think around $1 over on the front month versus the second month. You know, as a trader for 30 some years, and I would tell you that normally that's one of the first structures that we look at as overall market. Which way do I want to be in? It doesn't matter if it's a grain market, it doesn't matter if it's a livestock market, it doesn't matter if it's a metals market. When you've got a market structure like NYMEX crude is now, where you're seeing the front month over the back months, that's really longer term bullish. And one of the perceptions is, of course, is that there's more demand front end than there is back end. You know, if you look at storage right now, we see Cushing, Oklahoma around 40% below the 5-year average. You see overall crude oil storage somewhere around 6 to 7% below the 5-year average. So we've got supplies even a little tighter, yet demand is still elevated to some point. And so when we look at the back end, of course, the market's expecting OPEC to increase production, and that's part of the negativism that we're seeing in some of the back month futures. And normally what we always say as a trading side, and we used to be on the trading floor, is the public, more times than not, is usually wrong. And they have the back end of the curve, in my opinion, too cheap. If I look at the OPEC production, that's the biggest news that we've seen, basically, is, okay, we're going to increase, bring back the 2.5 million barrels. Well, if they do that, let's go back and look where we were last time they were at those levels. And if we do that, and I go back 2 years ago on the long-term charts, $75 a barrel. So, of course, we're seeing U.S. production is raised too, but demand is also elevated as well. If I look at jet fuel demand example, jet fuel demand is elevated. We're higher jet fuel demand in the North American, even actually Asia, for this time of year versus we were a year ago. And you would think that's impossible with the tariffs. But overall, I think the back end of the curve is basically too cheap. As a hedger, I would look to leave upside in the back end of the curve as I would look out in 26, 27. Whether you use callers, I like that, or whether you use outright puts and look to sell the calls later. But I think the market is undervalued. I think demand is there. So I think there's some upside left in the market. And like I said, if you hold a gun to my head and make me trade it one way or the other, do I think there's more risk in $7 to $8 of upside versus $7 to $8 of downside? I think the real risk is really to the upside with the geopolitical unrest that we've got with Russia, geopolitical unrest we've got with Iran, basically. I would just say that there's more upside in this market. Okay, we're not going to hold a gun to your head. I do want you to know that. So, but it is your money. So, so Thomas, what you hear that scenario? What do you think, and how are you running your business?
I love it.
You love it,
great.
Okay.
One of the hardest parts of our day-to-day job is managing sentiment like Dennis's, but pairing a business strategy on top of that. And at the end of the day, at Riverbend, we're an acquisition shop. Every acquisition we make, we're underwriting to the NYMEX strip at the time, and so we take a very aggressive stance towards protecting those cash flows. If we're underwriting at strip, we should be okay taking that risk off the table. Additionally, we are building this portfolio for an exit, and our exit is inherently unhedged. So for us, that in and of itself is enough commodity exposure. And then the other core tenet to what we're doing is cash flow recycling. So we are compounding our equity returns vis-a-vis taking free cash flow out of the ground, putting that back into future acquisitions. And so by implementing a robust hedging program, if we can lock in that stream of free cash flow, compound our equity returns, we're doing our job. And so I think we share similar sentiments to Dennis. I think we have some frustrations with when we see physical versus financial prices. But we have to table that when we're running a business, and our investors just don't like volatility. So anything we can do during our hold period to minimize that volatility, we're going to do.
It's kind of there's a lot of uncertainty. I mean, but Dennis has said the tariffs are here, but the effect has not been very large yet. But there is the uncertainty, but the prices honestly have not been moving that much. I mean, after Liberation Day, the price dropped from 70 to about 60, and it's ticked around 60 for a little bit. So I think of this as high uncertainty but low actual movement. And how do you respond to that?
Yeah, I mean, uncertainty is just never good for business and getting deals done. But you're right. I mean, I think we at Riverbend are very supportive of the current environment, very acquisitive in the current environment, and we see the setup for longer-term bullishness. There's just a lot of noise in the market right now, and I mean, energy is not alone in that. I mean, across the full economic spectrum, everybody's dealing with the same noise. We've heard a lot from the panelists today about the effects to drilling completion costs being somewhat minimal. That's one aspect of it. The other aspect of it is the global demand for the product we produce every given day. And it's just an unknown that we have to manage and be prudent with our acquisition efforts and pair a hedging program to insulate ourselves from that.
Okay, just sort of a more variables than usual situation. So, Billy, first you mentioned to me, obviously, that Wincoram is about to change its name, and I want to know if you want to talk about that first, and then I will have a question for you.
Yeah, we announced about a month ago we're going to be collapsing and merging with our joint venture partner, Stoneridge Asset Management. We started right in the middle of COVID, which is a crazy time to start a business, but it has worked out well. We've deployed almost $7.5 billion with our JV partner, and we're doing this so that we can do that in a bigger and faster way, going forward here. So we will no longer be Wincoram. When we're done, it'll be Stoneridge Energy.
Stoneridge Energy.
Stoneridge Energy.
So I got the name wrong when we were talking about it earlier. So Wincoram, about to be Stoneridge, is heavily focused on gas, does a lot of swaps. So, I mean, talk to me about that strategy and how it's working right now.
Yeah, so when we started, what we wanted to we thought with, a natural gas market, crude was negative at the time when we started, so no one wanted to touch it. But a natural gas market that had gone from 50 BCF a day to over 100. And we just thought that for the production side, the P out of the E&P, there needed to be more transparent and efficient way to capitalize the market, and that is where we wanted to be focused on gas production. And we have been, like I said, deployed a lot. We probably have almost 16,000 wells.
Okay.
Across 6 different basins. So, and in that, and in our structure, it is very important that we hedge to protect those cash flows, like Thomas was saying. And that's really our role in the market. We're the yield people in this market, and that's what our investors want. They want certainty. So we started out, and every deal we've done has been different. We started our first deal, we bought some assets from HG Energy and Appalachia. We did physical fixed price transactions for 7 years. It was hard. It was real hard. And at the point, so it was basis, it was fixed price. And the last deals that we've done, we've now, like Dennis was suggesting, we're doing collars and not just swaps. And part of that is our view on the market, but also protecting the downside, for our investors. So we've had to go from swaps to collars here to make sure that the size that we're doing, we've probably hedged across those deals almost 2 TCF of gas.
Okay.
So and that's a lot for the market to absorb that level of risk across, the counterparties. So for us to continue to do what we're doing and do it in a big way, we try to evolve with what the market avails us, but still protecting downside.
Who are your investors mostly? Because you talked about protecting them and ensuring them certainty.
So the majority are large institutions that are some insurance companies as well. Yeah, so they write a long-term annuity to somebody, and they want the income back over time. So that's really the main. It's that simple.
All right. No, I mean, the certainty is the key thing, and there's a willingness to pay for it.
Yeah, exactly. And that's the main thing, is they will willing to pay for it for that certainty. And really that's when we, been able to partner with other people, other operators that want the upside. We're not into development for that reason, right?
Okay.
So that we can have that certainty, for our investors and ultimately their customers.
Okay. So Dennis, we mentioned tariffs, and the landscape has changed quite a bit it's been 2 months and 2 days since Liberation Day, and things have moved up and down, but you have said the effect so far has been muted, and I'm interested in hearing about that, and I'm also interested in what are you looking at as you consider whether these tariffs may, or whether the uncertainty around them may have an effect on the economy in general, and of course then the prices of oil and gas.
Well, what I would say is, the tariff deal when it first came out was overblown, I think, by the press generally. It put a lot of fear, it put a lot of panic in the market. We saw panic go in the S&P 500 futures, the Dow Jones futures. We saw it go through some of the major moving averages. A lot of hedge fund managers use those futures contracts to go in and balance their book, instead of trying to get out of individual stocks. That way they can sell big blocks really quick. And when you see that kind of pressure, I believe it was over-exaggerated, because when President Trump came out and said that he was going to raise tariffs, whatever, and it went to 50, 100, 150%, whatever it was, it's a negotiating tactic. But the public I don't think really understands it. I think they're starting to begin to understand it now. I feel that if they get to 8 or 10%, it's going to be a huge win. But to get there, you're seeing the door in the face type approach, and it caused a panic in the market. No doubt it didn't. It did cause a panic in the energy market as well. And I believe OPEC, President Trump promised lower prices to the American public for energy, and I think he got OPEC to help him out with that. And I think that's going to continue for a little while. But OPEC is very famous for changing gears very quickly. And they'll take a point of pain for a certain period of time before they reverse what they're doing. So I think we're just buying time here. They're buying time, buying a low price to help the U.S. consumer here for a little while. I don't believe tariffs are inflationary. I believe that's overblown as well. And I think that the majority of that is we've had tariffs raised before in the previous administration when Trump was there, and we never really saw the inflation. So what happens, I believe, is it comes a cost structure of what it really is going to be in the end, and I think the market's starting to figure that out. We saw the S&P 500 futures, go above the 100-day, 200-day moving average. We're in a bull market again, right? TSA said what over the weekend? We had record travel for Memorial Day weekend, right? So has anybody been to Walmart lately? Are you seeing less people at Walmart? I'm not. I'm seeing more. I have to bypass it. I can't stand to park in the parking lot, right? So I think that's part of the fear factor is over. So eventually I think that comes back to the energy sector. We saw some demand destruction, no doubt about it. We saw some less driving happen. We saw Asia especially back off. But I think if we saw Singapore gasoline prices the last week went to a 4 or 5 month high. So I think the fear part of the tariff factor is over. We're realizing it's not such a big deal. I think you're going to see the inflation part comes back, and I'll try to speed this up a little bit, but the inflation part that people don't understand, it came back from when the M1 money supply that happened after COVID, when they increased the money supply basically by 300%. A lot of that M1 money supply is still out in the public, and that's what's keeping the inflation going. So probably what I see going forward from being a negative part that could possibly happen to our industry, to possibly happen to the U.S. economy is if we continue to not balance the deficit that we have. And I think that's what you're seeing the market starting to price in, starting to look at. You're seeing the price of gold making new highs, right? So I think one of the things that people have to look at or be prepared for is look at the 10-year Treasury note. And all you're seeing in the press, and you watch CNBC and some of these other publicists, they're saying, how many interest rate cuts are we going to have? 2, 3, 2, 1, maybe none. They can cut the short-term rates all they want to, but the long-term rates, when they don't come down, that should be a little bit of a fear factor. And my question to you people would basically be, if we took the 10-year Treasury note to 6 or 7%, what's that going to do to the U.S. economy? What's it going to do to the oil business? What's it going to do to the drilling side, right? So I think that's the factor that we need to be looking at. That's where I think the tariffs come in to finish up here, is I think President Trump and the administration is trying to do something to back in to basically bring that deficit down. Now, whether tariffs are going to be able to do that, that's going to be the big question. I can't answer that. But we're going to need to bring that deficit down, or there is going to be a little bit of a problem, I foresee, in the distant future. But taking that away, demand is still going to be there, I think, for crude, at least in the near term. It's going to be there for natural gas, especially with AI coming on. So longer term, I'm still bullish, but that's my fear factor, is these back into these Treasury notes need to be watched.
Okay, so I'm hearing a lot of things there, and I definitely want to talk to you about Las Vegas in a second. But Thomas, I guess, like, when you hear that, is this checking boxes with you, or is this like I've got some other thoughts? Where do you come down on this?
Yeah, I mean, look, we're in a commodity business, and so we're used to day-to-day volatility, month-to-month volatility. I mean, what we can control is what we pay for assets and how we manage those assets. And so it starts with, sound underwriting, buying high-quality assets, capitalizing assets properly, and then hedging very aggressively. And so on the hedging side of the equation, you have to have a plan. You have to be able to table emotion and table recency bias, because that can just skew your opinion in the execution of the plan. Number two is you need to have patience and time to execute that. Number three, for us as an acquisition shop, we are very cognizant of our weighted average underwriting price. And if we see opportunities to take chips off the table at or above that, we do it. And so we just have a very consistent approach to it, and we just try to table kind of the emotion and then what's going on around us, things that we can't control, and try to just take some of that volatility off the table. I don't disagree with anything Dennis is saying, and we certainly talk about it a lot. But we just try to be very consistent in our approach and how to manage a business, because it is just inherently volatile, and so we're just trying to reduce that in any way possible.
All right, then let's get to a forecast that we've heard quite a bit about today, which is, and Billy, this one's for you. We're going to have data centers everywhere. We're going to need loads of natural gas to supply them. I know I talked to the people at Liberty Energy, and they are planning in Western Pennsylvania, they're planning essentially a data center where Liberty will provide the equipment, the generation, and Range Resources is going to supply the gas. And the idea is that we may see dozens, hundreds of these, and it's going to take lots and lots of natural gas. And I hear this so often that it sort of sets off my skepticism button, and like, is this really going to happen this way?
I think it is going to happen, but the question is how much, right? And I think that's really where we as an industry are working through all that, because what you just described, you think about from the wells to the watt, right? How much capital is needed to do exactly what you just said is tens of billions of dollars. Between drilling the wells, the pipeline, the power, the box, and the computers, that sit in the data center. So that's a lot of capital at risk. And I think that's really where we, as an industry, how many of those can we actually get financed and when? Now, we have people, the hyperscalers at the other end, who seem to have endless capital, right, from that standpoint. So I've seen estimates from as low as 2 BCF a day to 12 BCF a day, right? That's a wide.
I think we heard 2 to 18 as a range earlier today.
I'm wrong already.
So
but I think that is the key in when those come on and where, like you talked about. I've previous career was in trading for 15 years in natural gas, and I've never seen a situation like this in the supply and demand balances where that much demand is that mobile. We haven't set all the chess pieces yet. Is it in Appalachia? Is it in, Meta's in Entergy are doing things in Louisiana? And when you throw those boulders into the lake, it changes the overall supply and demand on a regional basis and done enough on a national basis here. So I think it's just something that at this point, if someone, as a trader, someone says, I know exactly what it's going to be, they're wrong, right? And I think it's something we're going to have to keep monitoring. It is a bullish sentiment. It's just a question of how bullish will it be and how quickly can we just dispatch all that capital and bring that demand on.
I don't know about, I'm not sure how much you're helping me with my own investments by telling me something big and unpredictable is about to happen. But I am curious, like, there's also very much the issue of where these plants might go, and just the ability to build a gas-powered turbine plant is a multi-year project at this point. I mean, I'm hearing 5 and 7 year delays. I mean, not delays, but just that much time from the time you want it till the time you can have it. I mean, all that figures into the mix, right?
Yeah, that's all the complexity, part of it as well, because do you have the turbines to create the power? If you have those, where do you sit in the queue for interconnects into the grid? Right, so it's not it looks very simple and easy on a spreadsheet, and we all know that it's much harder to do that. So I think that is hard to monitor, right? It's not like there's a daily report that comes out and, say, here's the internet or interconnect queue, and this is what's moving, and, it's going to be a lot of work, a lot of detail to understand exactly how the view of how this will play out, and when it will play out from a project completion standpoint.
One of the great phrases that I heard in this doing this job, I was reporting on a story, and somebody told me that a project they were planning was a home run in Excel, which doesn't count. It's not an actual home run. It's only a home run on the spreadsheet. Dennis, I promised to get back to Las Vegas, and you told me, like, this is one of your indicators that you look at. So talk to me about that.
No, it is. So, I mean, we look, there's a lot of things from the trading side we look at. Two of the things that I would tell you, the reason I think the economy is still really good, at least here near term, and I didn't mean to scare anybody with the 10-year treasury, it's something to look at longer term, but near term, we look at the load in Las Vegas, which is running around over a 90% occupancy rate on a lot of their weekends. We look at the price of beef. That's one of the big things, one of the big leaders in
Did you say the price of beef?
Price of beef.
Okay.
Steaks, the regular meat complex. But when we see the price of beef elevated, it normally means longer term, you're seeing a lot of buying of the high-end type of food products, kind of a discretionary income, so to speak. So we're seeing a lot of that push. I think we're seeing record high beef prices right now. That tells me the economy's in good shape. And that's where we went back to say there was a lot of over-exaggeration on this tariff thing. A lot of fear was put into the public that I think shouldn't have been done. And I think we're going to get back to a reality. So I think the fear is over for tariffs. Whether it comes through to play out like the administration wants it to, I don't know. I can tell you that it's probably more of a negotiating tactic, as I said before. But the energy space, in my opinion, is a good place to invest.
I mean, I think kind of what you're describing, what I'm hearing anyway, is there was a big announcement and people thought it was a big deal, and they sort of said, oh, maybe I should take stock of things before I do anything else. And then as sort of things didn't happen, they started going about their daily lives again. Is that fairly close?
That's true. And over on the crude oil side, for example, we had the least amount of longs those 4 days after, of course, the announcement. There was so much liquidation in the market that over-exaggerated the downside, and now we're starting to see that come back out. But again, with OPEC raising production near term, the market's going to sit here for a little bit. I think that we've got a little bit of a supply problem coming back, but demand's not going away anytime soon. I think you're going to see Asian demand pick back up as well, and that's going to help us overall.
Okay, we're in the 95-second range, so I'm going to fire out one last question. Thomas, we've talked some about hedging, but how do you avoid getting overhedged?
Yeah, I mean, it sort of depends on your portfolio. I mean, if you've got a big growth wedge upcoming, you can get to a spot where you're basically pre-hedging those volumes. I mean, that is a risk that we look at all the time. And I mean, the scenario where you have production curtailments and prices rise is a bad scenario for our portfolio. And so we're always risk weighting that, sensitizing on our PDP base, mean, when we go from operated to non-op to minerals, the strategy will fluctuate. Also with what do we have coming online over the next 3, 6, 12 months. And so it's something that we think about all the time. Bank covenants have restrictions on you on what you can do for good reason. We generally try to stay in the 60 to 75% range of PDP because that's a good comfort zone that gives us a little cushion. And then as new wells are either being drilled or completed, we'll start tacking on in anticipation of those volumes. And so, I mean, really, we try to be very programmatic about it and stick to our plan, do it over a period of time, not pick one individual day.
Just stay somewhere close to the middle of the seesaw and go forward.
Yeah, just try to keep the balance. That's right.
Beautiful. All right. Well, I see 15 seconds left on our clock. So I'm going to wrap this up, and I'd like you to thank our panelists for their time. I understand.